Remember 2008? I mean, that feeling of the ground just completely crumbling beneath the financial world? Well, you're going to want to listen to this, because there are whispers that history might be rhyming. A potential crisis is brewing, one that could hit around 2026. But this time, its heart isn't in the housing market. It's in this massive, kind of secretive corner of finance called private credit. So, is this just an echo of the past, or are we facing a totally new kind of monster? Let's dig in.
So that's the big question, right? Is history actually repeating itself? When you look at it, you can see the familiar ingredients. There's a mountain of debt, a really complex and confusing structure, and it's all happening in a secretive market that's kind of operating in the shadows. But does that same recipe lead to another sudden collapse, or something else entirely? That's what we're here to figure out. Okay, here's our game plan. First, we'll define the main character in this whole story, private credit. Then we'll get into the anatomy of this 2026 slow burn crisis. After that, it's the main event, a head-to-head showdown, 2026 versus 2008. We're going to uncover this game-changing idea called the inflation lock, and then finally, we'll lay out two possible futures and what you can watch for to see which way we're actually heading. Okay, first things first. Before we can even talk about the risk, we have to understand the market at the center of it all. So let's pull back the curtain on this new shadow economy of private credit. So what in the world is private credit? Well, normally, a business goes to a bank for a loan. Pretty simple. Private credit is basically a bypass around that whole system. See, after the 2008 crisis, banks got a lot more regulated, a lot more cautious. So these giant investment funds, they just stepped in to fill the gap, lending money directly to businesses. It's like a parallel financial system, and it's way less regulated. Let's actually trace the money here. On the left, you've got the traditional path, the one we all know. Your savings go into a bank, and that bank acts like the heart of the system, pumping money out as loans. But on the right, that's the bypass. Instead of regular savers, you have these massive investors. We're talking pension funds, endowments, funneling huge sums of money into private funds, and they lend it out. It's a completely parallel universe of lending. So who's actually involved in this? Well, the borrowers are thousands of medium-sized companies. You know, the factories and businesses that really form the backbone of the economy. They need cash to grow, to build. And who's lending it to them? Well, it's the giant investment firms, names you've probably heard of, like Blackstone and Apollo. They've essentially become the new bankers for a huge chunk of the corporate world. Okay, so now we know what it is. The next question is, how did this massive market, which was fueled by a decade of super easy money, suddenly catch fire? This is the story of the 2026 slow burn crisis. You know, this problem was a decade in the making. Just follow the timeline. After 2008, interest rates basically went to zero. For investors, that meant safe investments paid almost nothing. So where'd all the money go? It flooded into private credit, all in this desperate search for better returns, for yield. But then, the inflation monster showed up, and central banks had to hike rates faster than ever. All of a sudden, the entire system is caught in a debt trap, where everything has to be repaid at a much, much higher cost.
And this all creates a perfect storm. First, you've got the high interest rates. That's the storm itself. Second, you have the floating rate trap. Unlike, say, a fixed-rate mortgage, the interest rates on these loans float. They go up with the market. That means debt payments have absolutely skyrocketed. And third, the economy is slowing down, so these companies have less money coming in to pay off a debt that's suddenly gotten so much heavier.
Let's just put a number on that pain. 250%. That is the average increase in how much these companies have to pay just to keep up with their debt. I mean, can you imagine if your mortgage payment more than tripled, basically overnight? That is what is happening to thousands of businesses right now. It's just not sustainable. And all this brings us to the main event, the showdown. 2026 versus 2008. We're going to look at the echoes for sure, but more importantly, we're going to look at the critical divergences that make this a very, very different kind of beast. So why is everyone getting those 2008 flashbacks? Well, there are two really big reasons. First, both crises were built on excessive leverage, which is just a fancy word for way too much debt piled on a shaky foundation. And second, in both cases, the risk was hidden away in a complex, shadow market that regulators couldn't really see clearly. It is an unsettlingly familiar setup.
But this is where the stories really start to diverge. Difference number one is the asset itself. 2008 was all about a single domino, housing. When that one domino fell, it knocked over the entire global system. 2026, though, isn't one domino. It's more like thousands of little cracks appearing in hundreds of different industries all at the same time. This means the fallout isn't one big catastrophic implosion, but more of a slower, widespread crumbling.
The second key difference here is speed. 2008 was like a lightning strike, a sudden, shocking explosion. It was a bank run where the money just vanished overnight. 2026, it's more like a long, slow-burning fuse. The money that's invested here is called patient capital. It's locked up for years, so investors like pension funds can't just pull it out quickly. So you don't get a sudden panic. What you get is a painful, multi-year grind as that fuse just slowly burns down.
And that leads to the third and maybe the most important mechanical difference. 2008 was a liquidity crisis. The financial plumbing was just clogged. Banks couldn't get their hands on cash. 2026 is a solvency crisis. The companies themselves are just not earning enough profit to pay their debts. It's a fundamental problem in the real economy, not just in the banking system.
Now you might be thinking, okay, if it's a slower, more spread out crisis, why is it so dangerous? And that brings us to the single most critical factor, the inflation lock. This is the reason the old rescue playbook from 2008 just isn't going to work this time.
This says it all, really. Back in 2008, when the economy was failing, central banks had a simple playbook: cut interest rates, print money, put out the fire. But this time, the bank is basically chained to that inflation monster. If they cut rates now to save all these failing companies, they risk letting inflation roar back to life. So their hands are tied. They're locked in, forced to choose between two really bad options, which might just mean they have to let the crisis play out.
So, where does that leave us? Let's look at the two most likely futures, and, more importantly, what you can keep an eye on to see which path we're actually headed down.
So, the most likely outcome, what we'll call the base case, it's not a sudden crash. It's a prolonged reckoning. We're talking about a multi-year, slow grind of companies defaulting. This is going to cause deep pain for the pension funds and insurance companies that invested so heavily in this market. And it will probably lead to stagnant economic growth for years because a key source of credit just gets turned off.
But there is a much darker scenario, the bear case. This is where that slow grind turns into full-blown contagion. What if the defaults get so bad that major pension funds start running out of cash? They would be forced to sell everything else, stocks, bonds, you name it, just to raise money, which could trigger a collapse across all markets. And there's a 21st century twist here, too. The source material warns about a targeted cyber attack on this new financial plumbing, creating a kind of chaos we've literally never seen before.
So how can you track this yourself? Well, keep an eye on these three indicators. First, corporate bond spreads. That's basically the gap between safe and risky debt. If it's getting wider, that's a sign of stress. Second, private equity realization rates. Are these big firms still able to sell the companies they own? If they can't, it means the market is seizing up. And finally, CLO default rates. This is the best public proxy we've got for stress in these secretive private loan markets.
Which leaves us with one final, pretty unsettling question. In 2008, the problem was a system that could freeze. It was a plumbing problem, and the central banks had the tools to thaw it out. But if the 2026 problem isn't a freeze, but a fundamental sickness in the real economy, and if the financial doctors are chained up, unable to actually administer the medicine, are we facing a crisis in a system that, this time, simply can't be saved?